Hey everybody, the stock market is at all-time highs, but there are still bargains to be found. Before Tyler and I dive in, take a minute and click subscribe to this channel and check out the link you see on your screen for a message from my sponsor, The Motley Fool. It's the best way to support this work we're doing. So I'll go first with one. There are some stocks that are still trading for pretty bargain basement valuations, and one area is the real estate sector. Real estate as a whole has underperformed the market, not surprising because these are very interest rate sensitive stocks. And the ones that tend to be the most interest rate sensitive are the ones with the least tenant risk. If a company if pays a high dividend, has essentially great visibility into their income, they tend to trade like a bond. When interest rates rise, bond yields rise, high or low risk investment yields rise, and price and yield have an inverse relationship, so these stocks have gotten beaten down. One in particular that I love right now is Easterly Government Properties. Ticker symbol is DEA. Now, as the name implies, this is a government property REIT. They own a portfolio of 90 properties, pretty large properties, about 9 million square feet in total, and they are almost 98% leased, and their only tenant is the US government. Now, this stock is down 44% since the beginning of 2022 when the interest rate hike cycle started. But it's just because of the interest rate cycle primarily, not because of anything wrong with the business. I'll get to a couple of concerns a little bit later. So, I mentioned 100% of their properties that are leased to the US government. Now, half of them are office properties. They own, like, the ticker symbol DEA, that they own some DEA office buildings, they own FBI office buildings, a lot of government agency office buildings, but these are mission critical office buildings that are needed. These are not the office real estate where they could say, everyone just go virtual, it'll be fine. So not that type of office property. They own a lot of VA medical facilities, outpatient medical facilities leased to the VA. That's the second biggest part of their portfolio, and they grow by both developing and acquiring properties, both of which they did in 2023 and continue to do. All of their leases are linked to the CPI, so they're inflation protected. So if inflation were to, say, spike again in 2024, their lease income would go up accordingly. And just to kind of show you how resilient their properties are, every lease that expired in 2023 was renewed by the US government in their portfolio. They have over an 8.3% dividend yield as I'm speaking, and they trade for just 11 times funds from operation, or the real estate version of earnings. Now, debt is a concern. If this was a REIT that did not have such revenue visibility, I would be much more concerned about the debt. Their debt is roughly 50% of their entire capitalization, roughly equal to their market cap. For a REIT, that's about twice as high as I'd like to see. Um, the near-term maturities are very low. About $160 million of their debt comes due this year. They've had success refinancing with reasonably priced debt. I'm not terribly worried about it, but that is a concern. But even with that, just the great portfolio, the unmatched revenue visibility that Easterly Government Properties has, makes this a bargain basement stock for me right now that I am looking at very closely. Tyler, what are you looking at? You're muted.
Did it again. So I'm looking
You're
at
you're good.
the RMR group, a very obscure kind of just benign name that doesn't mean anything, but it used to be called the REIT Management and Research Corporation. Um, there's when you have REITs like you just talked about with Easterly Government Property, there's kind of two kinds. Um, well, in this sense is like there's internally managed ones, which seem a little bit more like a corporation, where there's a management team in place making all the decisions for the trust, uh, much like you would expect a business, making the acquisitions and doing things like that. Then there's the externally managed REITs. Externally managed REITs is basically like a group of properties and a board of trustees, and the board of trustees hires an external manager to, you know, manage the properties, make sure that they're leased up, consult the board or the board of trustees to say, hey, we think it would be good for this REIT to make this acquisition or make this disposition. And the external manager typically gets paid a fee. Fee is normally like a very small percentage of revenue annually or something like that. And So as a percentage of revenue, it's obviously advantageous for the external manager to grow the revenue of the business. The RMR Group is one of these external managers. They have about $35 billion worth of real estate under management, both through publicly traded REITs and through private real estate companies. They're relatively smaller REITs that are a part of their industry. I think one of them is like net lease operating properties or something like that. It's again, they're not like household name REITs, but there's, I mean, you and I have been looking at REITs for a while. There's lots of them, and they have about 6 or 7 of them, and then they also have, like I said, some private assets. What is so interesting to me about this business is I think it's a little bit mispriced right now. They just made an acquisition of a company called Crowe, which is a private real estate company, and it brought in a lot of multifamily residential properties into the RMR group. Previously to this group, they didn't have a lot of to this acquisition. They didn't have a lot of residential, and they were a little bit more exposed to office, which in today's market, a lot of people see as almost like toxic assets, right? Like anybody that's a REIT, office REIT is trading for bargain basement prices. So right now they have about 14 to 19% of office space as their total portfolio, which is very manageable, and you can understand why that might be a little bit risky. But the good thing here is that RMR virtually no debt relative to other real estate managers because they don't own the property, so they don't have to take on debt. As of right now, I think their debt to capital is 5.5%, meaning that it's 95% equity, 5% debt. And at the same time, it's trading at a very, very cheap multiple. I think its price to free cash flow is less than 4 and has a dividend yield of 6.1%. So I can sympathize with the idea that it is maybe going through a rough patch of releasing office properties and something like that. But at the same time, the real estate market is muddling along in its own certain way. And I think that despite the troubles that the properties that manage have, I think the market may be overreacting to this particular company's stock or its business. And at that kind of valuation, I think it might be a good time to pounce.
Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by The Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.